Good morning, students. Welcome back to this discussion on accounting standards. Yeah. All right. So we have been discussing consolidation, and in respect of consolidation, AS21 is what we have been discussing so far. Okay. So today we plan to continue on that. And as we discussed, we'll also be moving on to another standard today that will be about associates. Okay. But yes, before moving on to associates, there are certain concepts and there are few examples as around consolidation. We plan to cover that. Okay. So now, in the previous session, we looked at some consolidation procedures. In respect of those consolidation procedures, we talked about line by line addition, which holding and subsidiary are required to follow whenever consolidated financial statements are prepared. That is one. On that line by line addition, we also understood that one of the adjustments could be in relation to goodwill or capital reserve plus minority interest, with which will start on the date of acquisition. Further, we also discussed that there could be various other adjustments which are required whenever consolidated financial statements are prepared. Like, for example, alignment of accounting policies, alignment of reporting dates, and if there are any intercompany transactions, intercompany balances, all of those are also required to be eliminated. Okay. To understand this, I think we covered few examples wherein we prepared the consolidated balance sheet. Okay, so we plan to cover something more. So let's move on to this example now. Yeah, so this is question 15. Okay. And again, I would suggest if you can just open this in your study material, that will be helpful because you can just keep referring to the question. Yeah, otherwise it becomes difficult for you to refer to the question. Okay. Yeah, so that will be helpful. Now, if you are looking at the page number, so this is page 10.73. Yeah, page 10.73, right? I can see one query coming up. So Hardik is asking, sir, if there is alignment of accounting policies, then we will add or subtract the same from pre and post as the case may be. So I think on this alignment of accounting policies, we plan to cover one example. Yeah. So in that example, we'll try to understand as to what all adjustments will be required to be made. Fine. Yeah. Okay. So now let's look at this example now. Yeah. Okay. So we have two companies, H Limited, which appears to be the holding company, and S Limited, subsidiary company, for which the information is given below. Yeah, so for these two companies, information is given below. Sales, then there's change in inventory. Change in inventory means closing stock less opening stock. Raw material consumed, wages and salaries. Okay. Production expenses. Then you have administrative expenses. Then there's selling distribution expenses, interest, depreciation. There's about two companies. Please understand that the numbers are in lakhs, right? Numbers which are given are in lakhs. Okay. So now in this case, some other information is also given to us. H Limited sold goods to S Limited. So this is an intercompany transaction. Yeah. Whenever there is an intercompany transaction, you have to be careful. And this transaction took place at 120 lakhs, wherein the markup is given to you. So cost plus 20% was the markup. Inventory of S Limited includes such goods valuing 24 lakhs. Means out of this intercompany sale, goods worth of 24 lakhs are still lying with S Limited. Okay. So can you tell me what all adjustments will be required in respect of this intercompany transaction? Over to you. What all adjustments you think will be required in this? I'm only talking about intercompany transaction. Quickly. Yes. Okay. So Tambeshwari says unrealized profit. Yeah, very good. So that means unrealized profit will have to be eliminated. Hardik says inventory sales and purchases. Yeah, so you mean to say that inventory at the first place will have to be eliminated? Yes or no? All right. Then I think Rashmi says reduce from P&L. Okay, then eliminate purchase and sales. Very good. That is what Ajay says. Okay. And Kasak is saying when you eliminate this purchase and sale, this will be worth of 24 lakhs. Yeah, that's correct. And Kasak is saying you also need to eliminate the unrealized profit. Yeah. Okay, very good. So can you now also tell me how do you compute unrealized profit? Okay, so I don't want the numbers. If you compute it, that's very good. How do you compute? So what is the methodology you will follow? And what is going to be the unrealized profit in this case? Over to you quickly. Yes. I think Hardik has shared the formula. Okay. So it appears that you are trying to compute this unrealized profit on the stock 24 lakhs. Yeah. Very good. All right, so let's move further. Good to understand. I received a lot of responses. Okay, I think Rashmi, Ajay, they have all shared this. Tambeshwari, very good. Okay, now let's move further. Yeah, so let's try to understand this further. Administrative expenses of S Limited include rupees 5 lakh paid to H Limited as consultancy fee. Selling and distribution expenses of H Limited include rupees 10 lakhs paid to S Limited as commission. So we can see that these two companies were not only selling and purchasing goods, they were also involved in some more transactions. Okay. Now tell me one thing. Will the elimination or will this intercompany elimination be limited to only the sale and purchase of goods? Or should this extend to every other transaction? Tell me quickly. So will that be limited to only sale and purchase? No. Preeti says no, it will extend. Means each and every intercompany transaction you'll have to eliminate. Correct? Yeah? Very good. Now, H Limited holds 80% of equity share capital of 1000 lakhs in S Limited prior to X1, X2. Now let's go back to the year. So this is X2, X3. So the information which is available is for 31st March X3. Yeah. Now H2, which held the 80% equity share capital, that was prior to X1, X2. Further, it says H Limited took credit to its profit and loss account the proportionate amount of dividend declared and paid by S Limited for X1, X2. Now, see in this question, the requirement is to prepare consolidated P&L. Yeah. And generally, this is what you will find. In the questions, either you will be asked to prepare consolidated balance sheet or the consolidated P&L, or maybe some of the adjustments like we have discussed in the previous sessions as well. Why? Because otherwise the length of the question will become very, very big, right? But if you can just observe that this question does not only require you to prepare the consolidated P&L. This is also trying to test your knowledge on intercompany transactions as well as balances. This is also trying to test your knowledge about this accounting treatment. Okay, so if you can just read this para around the dividend which has been recorded by H Limited. So what do you think? Is this accounting treatment? So in fact, in the question, the accounting treatment is also given to you. Yeah, so the transaction has been explained, and you have also been explained the accounting treatment which has been done by H Limited. So you are not required to do this. Accounting treatment is also given to you. So tell me one thing, that this accounting treatment which S Limited has done, do you think this is appropriate or this is not correct? You'll require some rectification. Over to you quickly. Do you think this accounting treatment is correct? Over to you quickly. Rashmi says it's correct. Hardik says no, this is not correct. It should have gone to cost of investment. Anil says this needs to be corrected. It's not correct. Okay, what about others? Tambeshwari says no, this needs to be corrected. All right. Preeti says not correct. So I can see a lot of responses are, in fact, majority of you are saying this is not correct. Okay, Ajay says no, it's correct. Okay, very good. What about others? What about others? Quickly, huh? So only few are saying it's correct. Kasak says it's correct. All right. So now, during the solution, which we'll do, we'll also try to understand this. Okay. All right. So now, let's move further. Now, we will get on to preparation of consolidated profit and loss. Now, in the consolidated P&L, our approach is going to be very simple. We'll have to do line by line addition. So P&L of two companies is given already. The problem is the P&L which is given is in the form of raw information. Raw information means the formatted statement of profit and loss is not available in the question. So that is something we'll have to take care of. Number one. Number two, when you add these two, so of course we'll keep adding these two, but when you add these two, we'll have to adjust some of those intercompany transactions. Yes or no? Yeah. All right. So let's start with this. Okay. So to begin, what do you have? You will have consolidated profit and loss. So you'll create the template or the format to begin with. And in the format, we'll have to place all the numbers like revenue, expenses, okay, cost of material purchased, consumed, cost of inventories of finished goods, employee benefit expense, finance cost, all of these things. Okay. And we'll have to give the note reference. Why? Because it belongs to two companies. So that's why it's better to have note for each item, wherein we'll just keep adding these. Yeah. Okay. So let's move on to the notes because all the workings are there in the notes itself. And if at all we believe some more calculations will be required, we can get on to some more working notes also. Okay. Now these notes, okay, these notes are not the working notes. Please remember, this is a part of the financial statement. Yeah. Working notes are going to be separate. Okay. Okay. Now to begin with, on revenue, what do you have in the information? 5,000 is the sale of H, 1,000 is the sale of S. So we will add these two, right? Now from this sale, we need to eliminate intercompany sales. So 120 is the intercompany sales, right? Now, if you go look at the question, it says administrative expenses of S Limited include 5 lakhs pays to H Limited as consultancy fee. Means H would have recognized revenue of 5 lakh. H would have recognized revenue of 5 lakh. So this is the revenue. this needs to be eliminated from revenue, right? Okay. Now, similarly, selling and distribution expenses of H. So these are expenses of H, but for S, this 10 lakh was what? This was commission income. This was commission income. Okay, so we'll have to eliminate this from revenue again, right? Yeah, 5865. Yeah, so it appears we do not have any further adjustment on the revenue, but still we'll keep the numbers as it is. We'll not place it in the consolidated P&L. At the end, we'll do, right? Okay, then moving further. Next item is cost of material purchased or consumed. Now, what do you have there? So cost of material purchased and consumed. We have raw material consumed 800 and 200 for H and S. Okay. Now, there is also an intercompany purchase. Yeah. This one. There's also one intercompany purchase, this one, which we have eliminated from sales. But from purchases also this needs to be eliminated. Yeah. This has to be eliminated from two places, right? Okay. So this will be eliminated from this place. Now, within the same head of cost of material purchased and consumed, we also need to include production expenses, because otherwise there is no separate line item for production expenses. Yeah, so these two items will take here 200, 100, right? And what do you get? 1180 total. Okay, then we have change in stock. What do you mean by change in stock? Closing stock less opening stock. So what is the amount of change in stock? 1000 plus 200 for two companies. Now, from the stock, if you eliminate any markup, so where will it impact? Change in stock only. Change in stock only, right? Now, we need to eliminate unrealized profit from this stock, correct? Now, in the question, you are told that the markup, the profit margin is 20% on cost. 20% on cost. Now, is this 24 lakhs the cost price? What do you think? Is this 24 lakhs cost price? Is this cost price of the inventory? Tell me, is this the cost price? Hardik says no, it's selling price. So therefore, if you have to eliminate the markup from this sale value, what do you need? You need the right proportion. Okay. So if let's suppose cost price was 100, what would be the selling price? If let's suppose cost price was 100, what would be the selling price? Vibhor says it will be 120. So that means 20 is the profit margin on selling price of 120. Okay. So that proportion you will use. So what do you get? 4 lakhs. Correct? 4 lakhs. Okay. Now this 4 lakh you will eliminate from change in stock. Okay. So this is also done. Right? Now, moving further, we'll keep adding the items. Okay. So then you have employee benefit expenses, which includes I think wages and salaries, correct? 800 and 150. On these two, there's no adjustment as such in the question, correct? Now, then you also have interest cost. So where will it go? Finance cost, 100 and 150. 150, sorry. Then you have depreciation, 150. Then there are some administrative expenses, selling and distribution expenses. So where will you take that? Other expenses. Okay, 200 and 100. Now, from these administrative expenses, you also need to eliminate the administrative expenses of S Limited. Yes or no? So administrative expenses of S limited, selling and distribution expenses of H limited. So at one place, these have already been eliminated. But what was that? Revenue. Corresponding impact was not considered. Yes or no? Yeah. So now you also need to consider the corresponding impact. That is 5 lakhs for the consultancy fee, 10 lakhs for the commission. Okay. So therefore, what do you get? 535. Yeah. So now we will place all of these numbers. So I think all of these adjustments we have made. Yeah, all of these adjustments we have made. So let's start placing all of these numbers in the P&L. So note 1, 5865. Okay. Then note 2, cost of material purchased or consumed. So what did we have? So we had 1180, right? Then 1196 will go to change of stock. 1196. Okay. Then employee benefit expenses 950. Finance cost 150. Okay, so let's place these two numbers 950, 150. Then you have depreciation and other expenses. So depreciation was what? 150. Other expenses was 535. Correct? And then you get total expenses and then the profit before taxes. Now, this is the information which is available in the question. So that's why we'll have to stop here. But one point is still left. And what is that? One point is still left. So if you look at the question, in the question, there's one more area, and that is about treatment of dividend. So let's talk about the treatment of dividend. Okay, now because I received a lot of responses from you and you discussed about its accounting treatment, which was quite different. Okay, so your views were different. So let's try to understand this. So the question says H Limited held 80% equity shares in S Limited. So let's try to look at this on the chart. So it says H Limited held 80% shares of S Limited prior to X1, X2. So let's suppose this is X1, X2. This is X2, X3. Okay. Now, for this particular period, information is available to us. So we are preparing P&L for this period right now. Correct? And this is the period. Okay. So this is the period. Now we don't know in which year H Limited acquired S Limited, but it appears that this is somewhere when H Limited held 80% in S Limited. Okay, so this appears to be the case. Now, H Limited took credit to its P&L proportionate amount of dividend declared and paid by S Limited for the year X1, X2. Now, somewhere over here, or you can say for X1, X2, dividend was declared. Okay. Now dividend was declared for X1, X2. Fine. Now tell me one thing, that when the dividend will be declared for X1, X2, let's assume this was declared on this particular date. This was the date when dividend was declared. Now on this date when the dividend was declared by S, where will it come from? It will come from, let's assume, profits of this year. Okay, as of now we don't have the information. So what will you say? You will say from the profits for X1, X2, dividend would have been declared. Yes or no? Yes or no? Correct? So dividend would have been declared from the profits of this year, correct? Now tell me one thing, that this period X1, X2, what will you call this as? Is this post acquisition period or pre acquisition period? Or do you think it falls under both? Is this post acquisition period or pre acquisition period? Hardik says it's post acquisition. Anil says it's pre acquisition. I'm surprised. Anil, tell me, how is this pre acquisition period? Otherwise, Vibhor, Tambeshwari, Ajay, they are saying it's post acquisition. Yeah. So anything which arises after acquisition, what do you call it as post acquisition? I think Anil has the same answer. Yeah. So this is post acquisition period, correct? So clearly this period is what? Post acquisition period. Okay. So if any dividend is declared in a relation to post acquisition period, and if that is also declared out of post acquisition profits. Why? Because we are not told that this dividend was declared out of pre acquisition profits. Then what should the parent company do as regards that dividend? Take it to P&L or reduce it from the cost of investment? Tell me, what should the parent company do? Rashmi says it should be taken to P&L. What about others? What should be done? Hardik says it should be taken to P&L. Yeah, Pranav, I think Vibhor, Anjali, Dilip, they have the same answer. Okay. Now, if you look at the question has given you the accounting treatment which H has done. So exactly what was required is what H Limited has done. Okay. So now in this case, do you think you need to now record this again? The answer is no. The answer is no. See, there are a couple of things you need to understand. One, the accounting treatment given in the question is absolutely correct. If that was incorrect, you would have rectified that in the solution. Yes or no? Okay. Yeah. And that too, in which year? That too, you would have rectified in this particular year. Yeah. Because for this year, you are preparing the consolidated P&L. But if everything has been recorded in an appropriate manner, so do you need to change anything or do you need to record that again? No, it's already recorded. It's already recorded. So that's why you don't need to do anything on this. Okay. Then I think Hardik has a query. Hardik is saying that, sir, nothing is mentioned about the date of acquisition. So, sir, we can take the assumption that date of acquisition is a date of reporting and we can assume it is pre-profits. No, I don't think your understanding is correct. Why? Because if you go read the question, it says H Limited held 80% equity shares of S prior to X1, X2. Okay, so what is your period prior to X1, X2? So that will be somewhere over here. Yes or no? So this information is already available to you in the question. Can you see that? Yeah. So you can't say that information about date of acquisition is not given. So the specific date is not given. But you understand that this is prior to X1, X2. Okay. So if you make any such assumption, that will be incorrect. Yeah. I think Anil has also stated the same thing. Kasak is saying, sir, let's suppose some rectification was required. Okay. So in the given question, rectification is not there. But if let's suppose some rectification was required. So if we correct this by posting it in P&L, then will it be added to the revenue? See, then of course you will take it to other income, not really to revenue, number one. And in that case you'll have to call it as prior period item, because it's an error which was made in the previous years, which you'll have to correct in the current year. And this will have two impact. One, your computation of goodwill and capital reserve would have been different, so you'll have to rectify that as well, depending on again the information which is available in the question. Okay, but that will be considered to be a prior period item because that was an error in the previous year. If you rectify that in the current year, which is the only option available to you, so of course you will take it to other income, but you will have to call it as prior period item. Clear? Kasat, clear on this? Yeah. Okay. So then I think Hardik is asking, sir, can we take direct expense of production also as other expenses? No. See, any expenses which are related to production, you can't call them as other expenses. Why? Because that's a direct cost for you. And direct cost is something which you will take to your consumption, cost of goods sold. That is what you call COGS as. Yes or no? So you have an item which is called as COGS. What is COGS? Cost of goods sold. And this cost of goods sold is the direct cost. This is the direct cost. Yeah, so you can't change this. You can't take some of the components of this cost to other expenses, because other expenses is more of indirect cost for you. Okay, so this is more of indirect cost. So you can't take your direct cost to indirect cost. So that will be incorrect otherwise. Okay. Tambeshwari is asking, change of inventory of finished goods is always negative. No. Let's again understand. So see, some of these questions you have been asking me, they are more of in relation to the preparation of the financial statements. But let's understand what is this change in inventory. So say your opening stock was, now I'll go with the numbers which are given. Now in the question, what is your opening stock? Let's suppose opening stock was nil. Okay, and let's suppose closing stock was 1196. Okay, let's suppose this is the information which is available. Okay, now this is the information which is available to you. It's 1196, right? Now, if this opening stock, so let's suppose this is 31st March 2000 x3 and this is 1st April 2000 x2. So that means on this date stock was nil, on this date stock was 1196. Okay, now a question for you. If the stock increases during the year, so will it have any impact on the P&L? Quickly, if the stock increases during the year, something which has happened in the current example, so will it have any impact on the P&L? Tell me. Rashmi says yes, Anil says yes. So what will be the impact on P&L? So if the stock increases, what is going to be the impact on the P&L? Tell me quickly. Profits will increase. Correct? Profits will increase. Ajay is saying reduce the profits. Ajay, again, you need to consider this. If the stock is increasing, will the profit increase or decrease? Tambeshwari, you tell me. If the stock will increase, so will the profits increase or decrease? Quickly, Neeru says profits will increase. Tambeshwari, over to you. If the stock will increase, so the profits will increase. Correct? Now, in the given example, this change in stock is what? Closing stock minus opening stock. Because this has an impact on the P&L, So that's why what do? You compute the difference of these two. So in this example, what was the difference? 1196. Okay. Now, how do you present this in the P&L? Change in stock is always required to be taken to the expense side. So whenever you will have your P&L, you will not take it to income. Change in stock is always required to be taken to expense side. And as we discussed, what is change in stock? Closing stock less opening stock. Okay. Now, because in the given example, you understand this change in stock will result in increasing the profits. So how will you present this number as negative or positive? Considering the fact you understand that this will always be taken to expense side. So tell me, how will you present it? Negative or positive? Tambeshwari, tell me, negative? Yeah. So what did you do? You presented this number as negative. Okay. But if in case, if let's suppose your opening stock was 2000, let me just change the numbers. Let's suppose your opening stock was 2000 instead of nil, and your closing stock was 1000. In this case, what will happen? Your stock has gone down, so you'll record that as expense. Yeah. So in that case, what will you do? So if this was the case, once again, you will call it as change in stock, but now you will present this as positive figure and not negative figure. Okay. Yeah. So understood as to why did we present this as negative in the current P&L. So this will not be always negative. So that can be positive or negative. Every time you'll have to just take care as to whether it should be positive or negative. Yeah. Preeti is explaining because if you go to the arithmetics, so minus and minus will become plus. Yes, that's correct. So that's the understanding you are applying over. Okay. Yeah. So everyone clear on this? Yeah. Everyone clear on this? All right. I'm just hoping there are no further questions on this. Okay. So let's move on to the next example now. Yeah. So let's move on to the next example. Okay, so let's look at this question 16. We'll discuss this now. Okay, so I think everyone is clear. Yeah, great. Dilip, Niru, Tanu, very good. Okay, so now moving on to this next question. Subsidiary B Limited provides the following balance sheet. So we are given some information about the subsidiary company. And in the information, we are given the balance sheet of subsidiary, only the balance sheet. Okay. So I can see this query from Larry. So Larry is saying, sir, the balance sheet and P&L preparation format will be understood in Schedule 3 clearly. Yes, that's correct. Okay, so I understand you also have this, you have covered or not covered, I'm not sure. But yes, of course. See, Schedule 3 is all about the format of the financial statements. And in terms of format, you understand as to how the financial statements will be prepared, which includes everything, a balance sheet, P&L, all the components. Yeah. So Schedule 3 covers that. So that's the prescribed format companies are required to follow. Okay. All right. So let's come back to this question now. Subsidiary B provides you following information. 2 years are given, x0 and x1. Now, in these questions, at times in the exam, this again could be a point of confusion over which some mistakes are also made. Yeah, so that's why you need to be taking care of some of these strategies also of the examiner. See, generally, whenever some information is given to you, generally, okay, so what will happen? Generally, what will you find? That the first column is for current year and the second column is for comparative year. Yeah. So that is something you will generally get to see. Yes or no? But in the current question, first column is for comparative year, then you have current year. Yeah. So you need to be mindful of some of these things. Sometimes what may happen is you may just ignore what is written at the top and you may just think that the first column is for current year and you may place the numbers in your solution accordingly and your entire solution may go wrong. Okay. That is where the reading of the question carefully becomes important. Yeah. Okay. So then I think we can just quickly flip through this balance sheet. So share capital is there. Then you have reserve and surplus. Then you have current liabilities in terms of short-term borrowings, trade payables, short-term provisions. Then on the asset side, you have non-current assets, PPE, non-current investments. Then some of the current assets are also given to you. Inventory, trade receivable, cash and cash equivalent, other current assets. Okay. And then of course, all the notes are given. On capital, it's only equity. Reserves, only general reserve. Short-term borrowings are only bank overdraft. Short-term provisions is the provision for taxation. So that's the only thing. Okay. Then PP is given to you. Okay. So gross as well as depreciation is given. Then you have other current assets, prepaid expenses. Okay. Then I think this further information is given to you. Yeah. So now this information is given. Now this is important for us. So let's try to understand this. Okay. Now what is this other information? B Limited is a subsidiary of A Limited. Very good. So that means consolidation will apply. Both the companies follow calendar year, which is again okay. So whether it's calendar year or financial year, but of course, you need to be mindful of that. Why? Because sometimes some proportionate period is required to be considered. Yeah, for the period you are required to do some calculation. So you'll be mindful now that this is the current calendar year. A Limited values inventory on weighted average basis. So we are given the accounting policy of A Limited. For inventory, it follows weighted average, while B uses FIFO, which is fine. Yeah. So if both the companies are using accounting policy, which is permissible by the accounting standards, so it is absolutely okay. To bring B Limited's values in line with those of A Limited, its value of inventory is required to be reduced by 12,000 at the end of X0 and 34,000 at the end of X1. Now, what is this? If you look at the financial statements of both the companies, A and B, are their accounting policies correct? Yes. But if you have to consolidate these two, then there could be a problem. What is the problem? Their accounting policies, even though they are correct, but they are not aligned. Yeah. Riddhi, I'll come to your query. Yeah. But yes, of course, you can see that. If those are not aligned, what do you need to do? You need to align them. And for alignment, what is the approach which the group will follow? All the subsidiaries will have to follow the same accounting policy which parent will follow, or at least for consolidation purposes, they will have to make the adjustment to bring the numbers in alignment with the accounting policies of the parent company. So if you do that, now the question doesn't require you to do that. So that exercise is also done by them. They are just telling you that if you do that, the impact is going to be good. So very simple, huh? So part of the question is already solved for you. So it says value of inventory of B Limited needs to be reduced by 12,000 at the end of previous year. And during the current year, yeah, so for this X1, at the end of X1, the value of inventory will go down by 34,000. Okay, great. Then it says B Limited deducts 1% from trade receivables as a general provision against doubtful debts. Now, in this adjustment, or you can say in this information, what B Limited has been doing is given to us. But we are not told about A Limited. Means what is it that A Limited has been doing? Yes or no? Yeah. So that means in this case, alignment is not an issue. In this case, alignment is not an issue. Yeah. So that's why what we can do is we can just ignore what is the accounting policy of A. We can just evaluate whether this accounting treatment which B Limited has been following, is that correct or not? Or is there any problem in this? Now B Limited deducts 1% from trade receivables generally. So every time there is a trade receivable, what B Limited will do is create a provision of debt, doubtful debts, 1%. Do you think this is appropriate? Tell me. If you go look at the requirements of accounting standards, do you think this is appropriate? Tell me. Tambeshwari says no. Why? Because you will create a provision for doubtful debts only when it is doubtful. Yes or no? Just because there's a debtor, can you just simply go and create 1% on an ad hoc basis? No, that will be inappropriate. That will be inappropriate. Correct? Yeah. Okay. So that means some rectification is required. Some rectification is required over here. Correct? Okay. So then I think Anil has a query. Anil is saying, sir, in case, so I think this is about inventory. Okay. In case those amounts were not presented in the question for adjustment of alignment of inventory valuation, what should be the adjustment and how can we determine those figures? See, again, depending on the requirement of the question, necessary information will always be provided to you. Okay. So if the question is not providing you that information, so that means question will have to provide you that part. Yeah. So please don't worry about it. So every time there is any such requirement, necessary information they will provide you. Otherwise, what will happen? Otherwise, you will get stuck. Okay. So don't worry about that part. Fine. All right. So now moving further. Prepaid expenses in B Limited include advertisement expenditure carried forward of rupees 60,000 in X0 and 30,000 in X1, being part of initial advertisement expenditure of 90,000 in X0, which is being written off over 3 years. Similar amount of advertisement expenditure of A Limited has been fully charged to P&L in X0. Okay, so now in this transaction, there are a couple of things we need to understand. One, accounting treatment which is followed by B Limited in respect of advertisement expense. Now, as we discussed, every time there is an accounting treatment, we need to check as to what is the parent company doing. Yeah. So we can say that what parent company A Limited has been doing is different from what B is doing, which is fine. Yeah. So at one place we may think that should we align this to the parent? The answer is yes. But additionally, we should also understand that whether B Limited or whether the accounting treatment which B Limited has been following is appropriate or not. Yeah. Like for this situation, as regards the valuation of inventory by B Limited. When B Limited was valuing the inventory on FIFO basis, can we say that the accounting treatment or this accounting policy of B Limited was not appropriate? Tell me. Can you say that? Tell me, what are your thoughts? Dilip says no. Why? Because if you go look at AS2, that is the accounting standard on inventory, it allows FIFO method to be used. Yeah. So on an independent basis, independent of A Limited, if you look at the accounting policy of B Limited, there was absolutely no problem in that. Okay. Now, when you go look at the accounting treatment of B Limited in respect of treatment of advertisement expenditure. So forget about what A Limited is doing. Let's try to analyze what B Limited is doing. So can we say that the accounting treatment which is currently followed by B Limited is correct as per the requirements of accounting standards? Tell me, what do you think? Is this accounting treatment correct? Hardik says, sir, AS26 only allows development expenditure to be capitalized. Ajay says, no, accounting treatment in this situation for this transaction by B Limited is not correct. So what should have been done by B Limited? What should have been done by B Limited? B Limited should have taken this entire expense of 90,000 to P&L. Yes or no? So in the year X0, this entire amount, 90,000, should have been taken to P&L. But instead of doing that, they are amortizing it. Means they have capitalized this. So is that permissible? No. So forget about what A is doing. On an independent basis, you need to evaluate that. And if you evaluate that and you find to be incorrect, so what will you do? You will have to rectify that. Yeah. So the financial statements or anything that will have to prepare will have to rectify this. Yes or no? Yeah. So now in this question again, even though the question is asking you about the preparation of the balance sheet, wherein you are also required to align their accounting policies. The examiner is also trying to test your knowledge on the accounting treatment of certain areas. For example, trade receivables. For example, advertisement expenditure. Okay. And this is something you should also expect in the exam, wherein you are not only tested on one area. Yeah. So you are tested on 2, 3 areas, yeah, in the same question. Yeah. So now, question says restate the balance sheet of B Limited. Why? Because the balance sheet of B Limited is already available to you. It's been already prepared. So you need to restate that. Restate means you prepare that again after considering the above information for the purposes of consolidation. For the purposes of consolidation means you will have to get this ready for consolidated financial statements. Okay, so that means you'll have to align the accounting policies of B Limited with A Limited in that set. Further, it says, would the restatement be necessary? Means, will this change in the balance sheet be necessary to make the accounting policies adopted by A Limited and B Limited uniform? So I think we discussed this. Yes, that's a necessity. Okay, so that's the requirement of AS 21. So we'll have to follow that. Yeah, so anyways, that will be required to be done. Okay, so that's a necessity, right? Now, moving on to this. So at the first place, what should you do? At the first place, some of these adjustments, some of these changes which are required to be made, we'll have to account for these. Correct? Yeah, we'll have to account for these. Now, there are a couple of adjustments which are due to error by B Limited, trade receivables and advertisement expense, and one adjustment which is in relation to change in inventory, that is due to alignment of accounting policies. So let's record all of these three. Now, let's begin with the reserves of B Limited on 2000 X1. So what is the amount of reserves of B Limited on 2000 X1? 7,14,000. So if you go look at the balance sheet of B Limited, yeah, so we can see this. So we are starting on this date. Yeah. Now, when the provision for trade receivables has been made in general and we understand that is incorrect, so what will you do? You'll have to reverse that provision. Yeah. So the impact of this provision would have gone to two places. One to the trade receivables and second to the P&L. Yes or no? So what will you do? You'll have to reverse that. You'll have to reverse that. Yeah. So if you reverse that, your profits will increase, your reserves will increase. Yeah. Because previously when you would have created the provision, the profits or the reserves would have gone down. So now you need to reverse that by increasing the profits. Correct? Yeah. Okay. So now, if you go look at the question, trade receivables amount is given to you. Okay. So amount of trade receivables is 8,91,000. Now in this case, what do? You understand that this number is net of provision. So currently this number is what? 99%. So if 100 was the amount, so this has become 99, and that is why that 99 is placed in the balance sheet. So now what do you need to do? You need to gross it up. So if you gross it up, what do? You'll divide this by 99%. So you divide 8,91,000 by 99%. So what will happen? You will get the gross amount, and from the gross, you will reduce the net amount to get the amount of impact. So if you can compute that, so what do you get? Quickly, if you compute that, what do you get? If you compute that, what do you get? Quickly. Hardik says 9,000. I think same is the response from Larry. Yeah. Anyone else? Quickly. Nitin is also getting 9,000. Great. Okay. So 9,000 is the amount with which the reserves will increase. Okay. All right. I think Neeru, Rashmi, they got the same answer. Now, the next thing. In relation to advertisement expenditure, 90,000 was the total amount in X0. 30,000 in this. 30,000 in this was charged to P&L in X0. Okay. In X0, 30,000 was taken to P&L. So was that correct? Yes. Remaining 60 was not taken to P&L in X0. No worries. In X1, again, another 30,000 was taken to P&L. So was that correct? Yes. So far, out of 90,000, 60,000 has been taken to P&L in 2 years, X0 and X1. So that means these reserves are after recording an expense of 60,000 in relation to advertisement. So what is the amount of error Is that 90,000? No, that is only 30,000. Okay, so far this 30,000 is the amount which should have gone to P&L, but which has not been taken to P&L. So that's why what will you do? You will reduce this. You will reduce this. Correct? Yeah. You will reduce this. So this will also go to P&L. Or you can say this will reduce the amount of reserves. Fine. Okay. So now advertisement expenditure has also been adjusted by us. Now you may be thinking that why are we considering all of these adjustments only for X1? Because if you go look at the question requires you to prepare the balance sheet only for X1. Yeah. So for the comparative year, you are not required to present it. That's why. Yeah. Now, next adjustment is in relation to inventory. At the end of year X0, inventory should have been reduced by 12,000. Okay. So if you reduce the inventory by 12,000 at the end of X0, so what will happen? Your opening stock next year will again change. So your closing stock, opening stock for these 2 years will be sort of adjusted. They will be balanced out. Yeah. The only problem is what? That is in relation to 34,000. So this has not been adjusted. Yeah. So you need to reduce the inventory by 34,000. So if you reduce the inventory by 34,000 closing stock, so will it lead to reduction in the profits or increase in the profits? This will lead to reduction in the profits or increase in profits. We both say reduction. So that's why this amount again needs to be deducted from the reserves. Yes or no? Yeah. So this again needs to be deducted from the reserves. Yeah. Okay. So now if you do this, I think we can get the amount of reserves recomputed after making all of these adjustments, whether that is due to error or due to alignment of accounting policies. Okay. Then please remember, in this calculation that we have done so far, these three adjustments which we have made, whether that is about trade receivables, inventory, or advertisement expenditure, that has been made only at one place. But every time, whenever there will be a rectification, dual impact needs to be considered. Yes or no? It will have to go to two places. Correct? Yeah. So we'll have to look at the other place when you go prepare the balance sheet. Okay. So Tambeshwari has a question. Tambeshwari is saying, can we please discuss this advertisement expenditure? Yes, sure. Now, if you look at the advertisement expenditure, Tambeshwari, question says total amount was 90,000 in X0. Okay. Yeah. Total amount was 90,000 in X0. I think Kiran just shared something. Okay. I'll come to that point. Out of this 90,000, if you go read the question, it says 60,000 was left at the end of X0. Means out of this 90,000, 30,000 was taken to P&L in X0. We have the calendar year right now. Okay. And another 30,000 was charged to P&L in X1. Okay. So that means in 2 years, out of 90,000, 60,000 is already charged to P&L. Now, Tambeshwari, tell me one thing. Around this advertisement expenditure, what is our objective? What is it that we are looking at? We want to take it to P&L, entire amount. Yeah. So what is it that we wanted to do? that this entire 90,000 should go to P&L? Yes or no? Yes or no? Tell me quickly. You're there? Yeah. And we understand out of 90, 60 has already been charged to P&L. Yes. So what is the balance amount that we need to take to P&L which has not been taken already? You tell me. 30,000? Yeah. So that's why now when we are making this rectification, what do? The balance 30 which has not been taken to P&L, we will take it to P&L. Understood? We will now take it to P&L. Okay. Clear on this? Yeah. Okay, very good. So now, okay, so Kiran mentioned, sir, why opening stock is to be ignored as the opening stock plus purchases less closing stock is profit. Sure, I'll come to this point. Don't worry. Okay. So let's get done with this and then I'll come to that point because I think you'll have to get onto the concept of the opening stock for that. Okay. Okay. So now let's try to place the balance sheet. And when you go look at the balance sheet, what should you do? You should go to the notes. So now, if you look at the question, will there be any change in the share capital? No, that will remain same. If you go look at the general reserves, so what will be the amount? It will remain same. So general reserve will remain same. Same means something that we just computed, 6,59,000. No further adjustment is required. Okay. No further adjustment is required. Then next item is bank overdraft. Is there any adjustment in that? No. Provision for taxation. Is there any adjustment in that? No. Property, plant and equipment. Is there any adjustment in that? Again, no. So all of these numbers you can place as it is. Yes. Then comes the next item that is about, I think, inventory. For inventory, in the question, note is not given, but now it's better you create the note. Why? Because there's a change in this. So inventory in the question is 7,42,000. That is 7,42,000. Yes or no? And we need to reduce the amount of inventory. So that's why we'll have to reduce it here. We'll have to reduce it here. Yes or no? So what is going to be the balance of inventory? 7,08,000. Correct? Okay. Now, trade receivable. Do we need to change this? Yes. 9,000 we need to add. So this will become 9 lakh. Correct? So you'll have to increase. Please remember corresponding impact you'll have to take two places. Okay. Prepaid expenses. On the prepaid expenses, what do we have? Prepaid expenses is, I think prepaid expense, if you go look at the question, where is this adjusted? Okay, so prepaid expenses, I believe this is required to be adjusted. So maybe this is cut. Okay, so now prepaid expenses, if you go look at the question, this is 48,000. Correct? And from this 48,000, what will you do? You will have to reduce that. Yeah, you'll have to reduce that. Okay, so now prepaid expenses, if you go look at, so this is where you have placed the prepaid expense. Okay, yeah. All right, so now are we left with any more items? No, I don't think so. So let's go look at the balance sheet. So share capital we have placed, reserves we have placed, short-term borrowings we have placed, trade payable. Then I think short-term provisions we have placed. Okay, so all of these things we have placed. Then PP is placed. Non-current assets, inventory we have placed. Trade receivables we have placed. Yeah, cash and cash equivalent, they will remain same. And other current assets again we have placed. Fine. Yeah. All right. So I think with this, we are done. We are done. Okay. But let's move on to this query of Kiran. So Kiran has a query. Yeah? Now Kiran is asking, Sir, in this adjustment, why did we consider only the, sorry, I think Bhavna has a query. Bhavna is saying advertisement expenditure included in prepaid expenses. So why record? No, so we are not recording that as it is. That has been reduced. Okay, so in the working note, that was not visible. That was not visible. So if you go look at that, I think Bhavna, if you go look at this number, so this has been reduced. So in the question, this was 48,000. In the question, this was 48,000. Okay, clear? Bhavna, clear on this? Yeah. Hardik, I'll come to your query slightly later. Let's get done with this. Clear? Okay, now let me just come back to this query of Kiran. Okay, so Kiran is asking, sir, why are we not adjusting the opening stock? Okay, now let's try to understand this. See, for the opening stock and the closing stock, I think we just discussed that any change in stock will have an impact on the P&L. Kiran, clear? Yeah. Okay. Now, let's suppose if you change the stock, now what is the amount of change? 12,000. Say this is your previous year. Say this is X1. This is X0. Okay. Now, whatever is the amount of stock, say on this particular date, let me just say that is X. Okay. Now, what is required? Question says that this closing stock at the end of previous year should be reduced by 12,000. Correct, Kiran? Yeah. So if you do this, then what will happen? You will make it X minus 12,000. Yes or no? Now, without this rectification, so if this rectification was not done, when you are closing stock as at 31st December, okay, so this is 31st December X0. So your closing stock on 31st December was X, and your opening stock, let's suppose on 1st April, X0, X1 would have been X again. So without this rectification, you would have considered X at two places in your closing stock as well as opening stock. Yes or no? Yeah. Correct. Kiran? Yeah. Now, when you change this X to X minus 12,000, so what will happen? Your opening stock will also change to what? X minus 12,000. Okay. Now, if you change both these numbers, so what will happen? Will there be any impact on the P&L? Will there be any impact on the P&L? Kiran, got this? Got this? Will there be any impact on the P&L? The answer is no. Why was there a problem? Because your closing stock as at 31st December X1 also required some rectification. So let's suppose that was Y. So in that Y, you had to reduce 34,000. Now, if that is not done, the profits would have changed. Okay, profits would have changed. Or you can say this would have been X minus 12,000 minus 34,000. Yeah, clear, Kiran, clear on this as to why we have ignored this adjustment. Because if you do this, then the same number will flow to opening stock and there will be no impact. But if the question would have required you to prepare the balance sheet as at 31st December X0, in that case, this adjustment would have been made. Why? Because in that case, you would have been, you need to show reserves, you need to show the inventory at their correct amount. As of now, you don't need that. As of now, what do you need? You need the correction only in respect of this. Kiran, clear on this? Yeah, clear? Very good. Okay, so then I think Hardik has a query. Hardik is saying, sir, I have a doubt in preference dividend. What will happen? And if interim dividend is given, what will happen? So what is the doubt? So if preference dividend is given, you will record that as preference dividend. If interim dividend is given, you will record that as income. Yeah, so that will be recorded as income. So that's how you'll have to treat that. Okay. Yeah. Kiran, Hardik, you're clear? All right. So Kiran is clear. Hardik, you're clear? So there's no specific treatment you need to consider. See, in the consolidated financial statements, the accounting treatment of dividend, what we have discussed, that's the only thing you need to remember. You need to understand if there is anything which is belonging to pre-acquisition or if there is anything which is belonging to post-acquisition. That is where the accounting will change. Understood? Yeah. Yeah. As regards this interim is always for the year. And interim something which you declare as a dividend. So again, therein you'll have to find out whether that is in relation to pre or post, because we didn't differentiate between that. We didn't call it as whether that was interim or final. In both the cases, you'll have to record the dividend income and you'll have to record the dividend income again, depending on whether that is pre or post. See, preference has not been captured, but there again, you will have to understand as to for what period it could have been there. It could have been there. Yeah. So that is something you may have to consider. Okay. Yeah. But again, this is not very specifically required. So you don't need to get into that. Anyways, I believe. Yeah. All right. So moving further, I think we will look at one more concept quickly, because this is briefly touched upon in your study material, and then we'll also look at some more examples again. Okay, so now there's this treatment of subsidiary company having preference share capital. Now, at times it may happen that there's a subsidiary company which has also got preference share capital. Okay. In such a case, what will you do? It will be appropriate for the parent to compute its share of profits or losses after adjusting any cumulative preference dividends of the subsidiary. Whether or not such dividends have been declared. Now, please remember, preference shares could be of two types, cumulative or non-cumulative. The moment you get to see they are cumulative and the preference dividends are cumulative. So what will happen? When the profits will be computed, so you'll have to adjust these dividends, whether these are declared or not, irrespective of that. Yeah, because that's the legal requirement which is placed to that. Because in case those are cumulative, they in any case are required to be paid. Okay, so year on year they may not be declared, but eventually that will have to be paid. That will have to be settled. So it is more of in the nature of interest. So that's the consequence. Okay, or you can say that's the obligation which is attached to such type of preference shares. But if in case preference shares are non-cumulative, then no such adjustment is required. Then you will not consider that dividend till the time it is not declared. till the time it is not actually paid. Okay, so this sort of situation you need to only consider for cumulative preference shares. Why? Because for them, dividend payment is something which is mandatory. Year on year, it may not come, but eventually this will have to be given. Yes, that's correct, Hardik. Yes, that's correct. Okay, yeah, all right. So I think what we can do is we can take a break now. Yeah, and I think after the break, we can just practice some more questions. And then we'll also move on to our next topic that is about associates. Okay, yeah. So let's take a break and then we'll continue on this. All right, great. All right, so let's look at one more example. So I think we can just practice something more. Yeah. So we can just take this example. Just give me a minute and let me just go to that document. Okay, so this one will do. Yeah. So this question 12. Okay. And Tanu is saying I'm not able to understand the calculation. So which calculation is that? I couldn't understand. Huh? Okay, so you've shared something. No worries. Huh? So maybe towards the end, I'll just reserve some time for this. Okay, and that is when we'll discuss this. Fine. All right. So let's move to this example now. Okay. Let's do this quickly. Huh? And then we'll move on to associates also. From the balance sheets of two companies and the information which is given below, prepare the consolidated balance sheet of Virat and Anishka as at 31st March. Okay. Virat holds 80% in Anishka since the incorporation. So in this case, the subsidiary has been incorporated. Okay, so it's not something which is acquired. So starting from the date the company was there, 80% is held by the holding company. Okay, so now we are given the balance sheet. So if you look at the question, so we are given the balance sheet of two companies. I think this is the standard balance sheet. In terms of the balance sheet, we have share capital reserves, then we have long-term borrowings. Yeah, so some of this information is given to you. Non-current assets, PPE, non-current investments, current assets, trade receivables. Yeah. Okay. So then the breakup of the capital is given. So it includes both equity as well as no. So only equity is there, but equity for two companies is given separately. Fine. It's a columnar. That's why. Okay. Then you have reserves for two companies. They were same, and this is the date 31st March X1. Okay. And then the information about non-current investments is also given to you. All right, great. Now, in this case, we are required to prepare consolidated balance sheet. So every time you get into the consolidated balance sheet, so can you tell me what should be your first calculation quickly? So every time when you move on to the consolidated balance sheet, so what should be your first calculation? Over to you quickly. Quickly. Yes. What is it that you need to solve first of all? Very good. Hardik says goodwill or capital reserve. Correct. I think same is the response from Rashmi. All right. So I think let's get on to that part first of all, because balance sheet anyways will be able to do. And of course, there will be a minority interest. Okay. So now two companies are given. If you look at the reserves of the subsidiary company, yeah, all the reserves are post acquisition. Yes or no? No. If you look at the holding company and the subsidiary company, okay, so for these two, what do you need? You need the reserves balance, and for subsidiary, you need the net assets. So for subsidiary, if you go look at the net assets, this is 4 lakh plus 1 lakh. 4 lakh plus 1 lakh. Okay, and 20% of that is what? Minority. 20% of that is what? Minority. Correct? Now, this 1 lakh is all belonging to post acquisition period. So therefore, will any portion of this exist on the date of acquisition? Tell me, this reserve of 1 lakh, can we say that this will exist on the date of acquisition? No. Why? Because when the company was created, there was no reserve. Okay, so that means on the date when the company was acquired, it would be having only the equity share capital. Correct? So if you go look at the net assets, how do you compute the net assets? That's how you compute it. Equity plus reserves on a proportionate basis. So what is going to be the net asset of this company? 3,20,000. 3,20,000. And if you look at the cost of investment purchase consideration, that is again 3,20,000, which ideally should be same only if this is a incorporated company. So that's why in this case, what is going to be the amount of goodwill? Nil. It will be nil. So does it mean that we will have capital reserve? No. Because if the goodwill is nil, capital reserve is also nil. Clear? Clear on this? Yeah. Now, as around the reserves, because entire amount of reserves is after acquisition. So what will you do? A portion of this minority will take up, and the remaining portion, 80,000, that will go to holding company. That will go to holding company. Okay. Now, as a next step, what do we need? We need to place these numbers in the balance sheet. That's it. We just simply need to place these numbers in the balance sheet, and that's it. Right? So let's get on to that. Yeah. Let's start placing these numbers in the balance sheet now. Okay. So now, what do you do? First of all, we'll get on to the notes. Yeah, because in the notes, we'll get a clarity of adding some of these numbers. So share capital of holding you'll take. Will you also pick up the share capital of subsidiary? Tell me, will you also pick up the share capital of subsidiary? Hardik says no. Why? Because share capital of subsidiary will get knocked off against the investments of holding. Okay. And in a way that has already been captured while computing the goodwill or capital reserve. Okay. Then on the general reserve, you will start with the reserves of holding. Yes. To which you'll add the portion which will come from subsidiary. 80% will come from subsidiary. Why? Because 20% minority has taken. Okay. So this becomes 1,80,000. Then minority we just computed in the working note. So we can give the reference of working note. Long-term borrowings. Holding company is 2 lakh. Minority is, subsidiary is 1 lakh. Do we need any adjustment here? No. There's no such adjustment. Okay. Then next item is trade payable. For holding 1 lakh. For subsidiary, again 1 lakh. Do we have any adjustment? Again, no. PPE, holding 4 lakh, subsidiary 3 lakh. Do we have any adjustment? Again, no. No adjustment. Correct? Then non-current assets. Do we need to add that? Non-current assets. Do we need to add that? Tell me quickly. Should we add that? Abhishek says no. That will not be added. Yeah. Preeti, Niru, they are saying no. Why? Because that's been knocked off. Okay. Then you have inventory. Holding 1,60,000, subsidiary 2 lakh. Okay. Then you have trade receivables 80,000, subsidiary 1,40,000. Again, there's no adjustment. Yes or no? Cash and cash equivalent. Holding 40,000, subsidiary 60,000. Yeah. Okay. So I think all of these adjustments we have made. Now what we can do is we can just place these numbers in the main, or you can say the face of the balance sheet. That's it. Yeah. So it's all about placement. Now, when you will placing these numbers on the face of the balance sheet, please be very, very careful about the format. So this format should be in line with what Schedule 3 requires. Yeah. So in this balance sheet, the marks will also be there for the format. Because if you go look at the question, in the question, the format is also something which is in line with Schedule 3, but it may not be there always. So you may be required to do that. Okay. Yeah. So this is 6 lakhs. Yeah. So now we are just picking up the numbers. Huh? Yeah. So there's no further item which is not there in the notes to account. So all the numbers have been picked up from notes. Correct? Everyone clear? Clear on this? Yeah. All right. So I think with this, we can just sort of, conclude our discussion at first level on this. And we can now move on to next topic, that is about associates. Okay. So just give me a minute. I'll just open that document on associates. Okay. So we are going to start with AS23 now. So just give me a minute. I'll just open that document. All right. So now moving on to AS23. So AS23 is all about associates. Okay. So we'll just try to understand some of the points which are there in AS23 in terms of the concept, and then we'll pick up some examples as well. Okay. So now, in relation to the consolidation, we have so far talked about only one relationship, and that was wherein holding and subsidiary were involved. Okay. But every time in a group, or every time when the investor will make the investment, it will not be that of holding and subsidiary. So it could also involve a different transaction, means wherein the investor is not getting the control. So I think we can just look at some examples. So let me just go to this working file. Okay, so we talked about the group so far. And every time there was a group, so what did we have? We had two companies, A Limited and B Limited. And every time when we were talking about these two companies, okay, so we discussed that A Limited has got control. Now, this is very, very important. Huh? A Limited had control over B Limited. What do you mean by this control? This control, you can always say, is a unilateral control. So it means only A Limited had control over B Limited and nobody else. Yeah. That is what you call unilateral controlance. And the moment there was a control, we called this as subsidiary of A Limited, and thereby consolidation was required. Okay, so this created the requirement for consolidation. And we also discussed that this requirement of consolidation doesn't come from AS21, but whenever you have this consolidation requirement, that is when you go to AS21. Remember that? Yeah, remember that? Yeah. Okay, now this requirement of consolidation is not only limited to the relationship of holding and subsidiary. It goes beyond that. So what does it mean? It means, if let's suppose in the given example, say A Limited doesn't have control. Okay. A Limited doesn't have a subsidiary. So I'm saying there's no subsidiary of A Limited. But let's suppose it has one associate company. Now, what is an associate? We'll talk about it. Let's suppose it has one associate company. So here again, who is the investor? A Limited. Who is the investee? C Limited. So A has made some investment in C Limited in a way that C Limited becomes associate of A Limited. Now here again, knowingly, or even if A Limited doesn't have any subsidiary, what will arise? Again, the requirement of consolidation will arise. And you may be thinking, sir, how is this possible? What do you mean by consolidation? Consolidation means A Limited will again, in a same manner, be required to prepare consolidated financial statements. So, which means that A will prepare its own financial statements. C will prepare its own financial statements. Over and above that, the CFS will also be required. But the methodology which will be followed for this CFS, okay, for this CFS will not be line by line addition. Line by line addition that you had will not be followed now. Why? Because this is not a subsidiary. Investee is not a subsidiary. Investee is an associate. So that's why in this case, consolidated financial statements will be required to be prepared by A Limited. But the method of consolidation will be something different. That we'll talk about. Okay, so we'll talk about that method as to what is going to be that method, how that method needs to be applied. All of those things we'll cover. Now, the next point is that how does this company A Limited get into this situation wherein C Limited is considered as its associate? Yeah, so let's try to understand about that. See, there was a situation wherein A Limited was having control over B Limited. Yes or no? So this was a control situation. And there is one situation wherein A Limited is getting something else in C Limited. Now let's try to understand both of these situations. And for your references, I'll just highlight these two. This is B and this is C. Okay, so we'll try to understand. See, when A will control B Limited, so what will it mean? It would mean that tomorrow, any decisions which are there in respect of B Limited, if there are any matters pertaining to B Limited, if there are any critical activities in relation to B Limited, so in relation to the decision making over those matters, who will be involved or who will have the final say? It will be A Limited. Means A will have the final say. A will have the power in respect of decision making. Okay. So tomorrow, if any decisions are required to be made, tomorrow, if any decisions are required to be made in respect of B Limited, so who will take those decisions? So those decisions will be taken up by, sorry, those decisions will be taken by A Limited. Okay. So that's the thought, that's the consideration that we have in respect of this control situation. Now, let's suppose other than A Limited, let's suppose A holds 77% shares of B. So thereby A has control over B. Now let's suppose there is another company D Limited. This company holds remaining shares. So what do you call this company as? Can you tell me? I think we talked about this company a lot. What will you call D Limited as? Quickly, what will you call D Limited as? Very good. Mane Tambeshwari says minority interest. I'm not sure why you are confused. We have spent so much time on consolidation. Yes or no? So, what do you call D Limited as? Minority interest. So, will this understanding change? No. So, D Limited is the minority shareholder and will continue to remain minority shareholder. Yes or no? Now, let's think about this company B Limited. This company has got two investors. Correct? B Limited has got two investors, A and D. In respect of B Limited, if any decision making is required, then who will have the final say? Tell me, who will have the final say? For any decision making, who will have the final say? It's A Limited. Yes or no? Tanu says A Limited. But what is the role of D Limited then? D Limited is also an investor. Net assets of B Limited on a proportionate basis also belong to D Limited. Any profits which B Limited will generate will also go proportionately to D Limited. Yeah. But D Limited has a problem. D Limited has a limitation. What is that? The decision making of B Limited is not controlled by D Limited. Yes or no? Yeah. So decision making is not controlled by D Limited. But there could be a situation. Let's understand that. Say B Limited has a board of directors and there are 5 directors, D1, D2, D3, D4, D5. Okay. So there are 5 directors of B Limited. Okay. So B Limited has a board wherein there are 5 directors. Out of these 5, D2, D3, D1, D4, they belong to whom? A Limited. And one director is from T5 is from, he represents D Limited, D5. Okay. Now, whenever there will be any board meeting in B Limited, so any matter, any decision making, any critical matters, who will decide that? Board of directors in a company? Tell me, yes or no? So, board of directors will decide, yes or no? Now, let's understand if any board meeting will take place in respect of any matter, every time, who will have the power to take the decision making? Who will have the power to direct the decision making? It will always be A. It will always be A. But can we not say that through this one director or through this only one director, D will not be able to exercise any power over the decision making, but D will always have the power to participate in the decision making? Tell me. At least participation right will be available to D or not? Yes or no? Yes or no? Riddhi says yes. That's possible. Bhavna says yes. At least participation right will be available to D. Yes? Or you can say B will always have the power to participate. Correct? Which cannot be denied. So we are not saying that through this power, B will take the decisions. Sorry, D will take the decision. No, we are not saying that. But every time any matter will be discussed, D will always be able to participate. Correct? Now, this power to participate, which D Limited has, what do you call it as? Significant influence. So, this is called as significant influence. It means that D has got significant influence over B Limited. Okay, so in this example, what will you say? You will say that D has got significant influence over B Limited. And the moment you say D has got significant influence over B Limited, so what will happen? So what will happen? The moment you say that, B will become associate of D Limited. Now you may be thinking, sir, B Limited is subsidiary of A Limited and an associate of D Limited. So is that possible? The answer is yes. And you may have a question, then sir, B Limited will be consolidated by A Limited as well as D Limited. Again, yes. What is the problem? But in such a case, when A Limited will consolidate B Limited, so A will do full consolidation, means line by line addition. But D will not be able to do full consolidation of B Limited. So what is going to be that? We'll talk about that. Okay, so that's a separate accounting requirement. We'll talk about that. Yeah, but for sure, D Limited will be required to prepare CFS, and in its CFS, D Limited will call B Limited as its associate. Okay, why? Because significant influence is there. Okay, now standard says, now let's come back to that other example, huh? A Limited and C Limited. Now, if let's suppose A Limited holds, if let's suppose A Limited holds 20% or more, shares voting right of C Limited, then the standard says it will be presumed that A Limited has got significant influence over C Limited. Yeah, but please remember, it has to be lower than 50%. Okay, so it has to be less than 50%, or you can say equal to also. Yeah, because the moment you cross 50%, so control will be established. Okay, and in such a case, this C limited will be called as associate of A limited, wherein A will be required to prepare two sets of financial statements. One, standalone, means its own financial statements. Second, consolidated financial statements. Okay, everyone clear on this? Yeah, everyone clear on this? Great. I think Preeti has also shared this just now. Very good. So what we will do is we'll just pick up some small examples around this, the part that we just discussed. Very small examples. Okay. Very much on the similar line that we just discussed. A limited has 70% holding in C, and B limited also has 28% holding in the same company. So A holds 70% in C, B holds 28% in C. So in this case, A limited with the majority shareholding, that is more than 50%, will be called as parent company for C. Correct? And because B limited holds more than 20%, but less than 50%. So therefore, C limited will become associate for B limited. Okay, clear? Okay, Kasak has a query. Kasak is saying, sir, means standalone financial statements are prepared in case of associate only. No, no, no. So unnecessarily you are getting confused. Huh? When we were doing consolidation under AS 21, so in that case, you tell me, were two companies, both holding and subsidiary, were they preparing their standalone financial statements or not? Tell me, were they preparing their standalone financial statements or not? Yes. So why you are thinking that it will be required in case of associate only? Okay. Yeah. Okay. So don't get into that confusion. Huh? So we are saying that even here you have requirement to prepare two sets. But who has that requirement? That is for the investor, not the investee. Only the investor needs to be worried about whether that investor has control or whether that investor has got significant influence. The point is that sometimes there is a confusion that, sir, consolidation should be done only when there is a subsidiary. But it's not like that. Even for an investor which has got only associate and not a subsidiary or not a single subsidiary, even in that case, consolidated financial statements will be required. Okay, so that's the understanding you need to have. Clear? All right, so let's look at one more example. Huh? A limited is holding 90% shares in B limited. Okay, and 10% shares in C limited. So A is holding 90 in B, 10 in C. In fact, I should draw this. I think I should draw this. Huh? So what I'll do is I'll just go to that working file. Okay, so we are told A is holding 90% in B. So this is A limited. This is B limited. So this is 90%. And 10% in C. So it appears there is another company, C limited, in which A holds 10%. Okay. Further, it says B is holding 11% in C. So B is also holding something. So B is also holding 11% in C. Okay. Okay. So in this case, as regards A and B, A has control over B. Correct. So therefore, B will become subsidiary of A. Yeah. Now, if you look at the relationship of A and C, now we are talking about A and C. Now their relationship. So it says A currently holds 10% shares in C directly and 11% in C indirectly. Yeah. So all in all, if one has to evaluate about C Limited, we can say that 21% shares of C Limited are held by whom? Two companies, A and B, on a combined basis. Yes or no? On a combined basis, A and B hold 21% shares of C. And because B is controlled by A, so that's why you can say A is indirectly holding 11% in C. Yeah. So if you have to analyze about the shareholding of C, this 21% means 10 plus 11 is coming from A. Portion of that could be direct, portion of that could be indirect. So the standard says it's not necessary that you will always have direct. So direct plus indirect, if that crosses 20%, then what do you have? If that crosses 20%, then what do you have? Tell me. Significant influence? Yeah, significant influence. So therefore, this C Limited will be considered as associate of A Limited. Now, can we make the same statement for B Limited? No. For B, we cannot say that this 10% is indirect. No, that will be incorrect. For A, we can say that. Why? Because A is controlling B. B is not controlling A. Understood? Yeah. So therefore, C will be considered as associate of A. Clear? Everyone clear? Clear? Everyone? All right. So now, moving further, I think we can just talk about the consolidation requirement now. And as the time will permit, we'll also look at one example. Okay, so now let's move on to the consolidation requirement. Okay, so now for an associate, standard says consolidation will be done using equity method of accounting. Equity method of accounting needs to be followed for consolidation purposes. Now, this is unlike line by line addition. Okay, please remember this is unlike line by line addition. So we do not have line by line addition here. So what do you mean by this? What do you mean by equity method of accounting? See, equity for the purposes of this consolidation means net assets. For the purposes of consolidation, equity means net assets. Means investor. So if you have investor A Limited holds 25% shares of B Limited. then this investor, okay, so A Limited investor has the right towards 25% net assets of B Limited. Now, if you remember when we were doing consolidation, okay, so this investor, which was also called as minority interest, yes or no? So every time for this investor, what were you doing? What were you doing? You were picking up the proportionate share of net assets. Tell me, you were picking up the proportionate share of net assets or not? Tell me, every time you were doing that? Yeah. Starting from the date of acquisition, starting from the date of acquisition, you were picking up the share of net assets. And on every reporting date, you were updating that. On every reporting date, you were updating that. Updating that means on the reporting date, you used to check what's the amount of net assets. So the proportionate share you were giving to the investor. Yeah, or that was recorded in the balance sheet. And any change during this period, okay, that would arise either because of the profits or the losses, or it could be for any reasons. Correct? Now, same methodology you need to follow in case of equity method of accounting, wherein what will you do? For this investor, you will have to check on the date of acquisition proportionate amount of net assets and proportionate amount of net assets on the reporting date as well. Yeah. So on both these dates, you need to compute these amounts. Okay. On both these dates, you need to compute these amounts. And every time when the investor will prepare the consolidated financial statements, please remember, every time when the investor will prepare consolidated financial statements, in that consolidated financial statements, investor will pick up only the proportionate amount of net assets of the associate company. That's it. So all the assets, all the liabilities, 100% basis will not be done. Okay, all the assets, or you can say 100% amount of the assets, 100% amount of the liabilities, the approach that we used to have in case of subsidiary, that will not be followed here. No, that will not be followed here. In this case, the only thing that we will be required to do will be to compute the proportionate amount of net assets of the associate company. And what will be the proportionate amount? If let's suppose net assets of B are 100, so 25 is what belongs to A. So A will record 25 net assets. Now, how will that be recorded? What all adjustments are associated with that? That will cover. Okay, so maybe we'll cover that with the help of an example. But I don't think we have time now, and we also need to reserve some time for your queries. Okay, so that will cover. Yeah. As of now, what do you need to remember? That this equity method of accounting is the approach that will be followed for consolidation of an associate company, which is significantly different from what we follow under subsidiaries consolidation, that is line by line addition. All right. Yeah. So any questions, any doubts so far? Because with this, we'll just conclude our discussion for today, and I'll move on to your queries. I understand you have some queries, which I have parked. Okay. So we'll just discuss some of those queries also. Otherwise, they will keep getting accumulated. Yeah. But any questions, any doubts, if you have on this, you may let me know. And then I'll move on to your queries. Yes, over to you. Any questions, any doubts? Quickly. Okay, Riddhi is asking, can I see on the MCA website, Schedule 3? See, if you want to go look at the Schedule 3, you can just do Google. Okay, of course, on MCA, you can see that, but you'll have to find the relevant section as to where it is appearing. You'll have to search that. Just do Google. Okay, on the Google, you'll get the formatter. Maybe now you can do that. Yeah. All right. Okay, so then I think Sambeshwari has a question, okay, that is related to amalgamation. No worries. And she's asking, sir, illustration 9 on amalgamation. So let me just go to that document. And when you say illustration 9, so which page is that? Okay, so that is 13.52. And on this, she's asking, sir, first entry of PPE, how do we calculate that? Okay, so now I think PPE of both the companies. Okay, so uh, Hardik, I'll have to come to your question maybe in the next session. I've made a note of that, but I'll have to come to that maybe in the next session. Okay, I've not been able to go through that. Okay, but I'll come back on that. Don't worry. Okay, now, okay, so quickly on the question which Tambeshwari has asked, and let me just also try to run that over here so that everyone can understand. So I'll just try to open this document. Just give me a minute. Okay, so this question which has been asked by Tambeshwari. Okay, so this is question number 9. Yeah, so if you want to open, you can also open this document, question number 9. Okay, so this is the one. And she's asking about this revaluation as to how you are getting this PP. So this first entry is what she wants to look at. Okay, so I'll have to just quickly go through the question. I haven't been able to go through this question as yet. Okay, so let me just go to the question first. Okay, so in the question, if we look at, sorry, let me just share this question with everyone. Okay, so this is the one that we have. Correct, Tambeshwari? Yeah. Now, in this question, PP seems to have been revalued. Huh? And where is this coming from? So it says PP of both the companies. So let's go look at the PP of both the companies. So in the question, is it given? Yes. So it is 7 lakh and 2,50,000. So which companies are these? P and Q. So there are two companies, P and Q. Okay. And then we are told PP of both the companies are to be revalued at 15% above the book value. Okay. So that is 15% above the book value. So let's try to understand that. So we are given PP of both the companies. So can you please also compute this and get on to this answer? Okay, so then I think there's some more fact pattern we'll have to look at. Huh? So in this case, just give me a minute. Huh? I'm just trying to compute this. Just give me a minute. Okay, so we have this Q limited. Okay. Yeah, so I think Tanu is sharing something in between. So Hardik is saying, sir, 1,05,000, 7 lakh into 15%. Okay. So if you compute this 7 lakh into 15%, so you get 1,05,000. So this is the amount which will get to a realization account. So I think you have done this for P Limited. Okay. And what about the other company? So for the other company, I think journal entries are different. Yeah. So that's why this number is visible. Okay. So in the question, let's try to understand. So they are asking for the journal entries of P Limited only. Okay, great. So I think if you go look at the requirements, Tambeshwari, they are asking for journal entries in the books of P Limited. Okay. So now when P Limited will record, so at the first place, what is it that P Limited is doing? P Limited is only considering its own PPE in this first accounting entry. Its own PPE on which if you pick up this 15%, so this comes out to 1,05,000. Then I think somewhere down the line, remaining assets must also have been captured. Let me just go down. Okay, so yes, of course. So if you go down, PPE of Q Limited has been captured. Clear on this? Tambeshwari, clear on this? Yeah. Okay, so then I think Anil has also answered this. Very good. And I think Tambeshwari has got this. Okay, great. Very good. All right, so any more questions? Okay, so I think Tanu has shared one screenshot. Let me just go look at that screenshot first. Just a minute. I'll have to open your screenshot. Just give me a minute, Tanu. Okay, so Tanu has shared the screenshot. Now, Tanu, what is your query? What is your query? Yeah, so I can see the screenshot you have shared, but what is the query that you are having? Quickly. Okay, so this is the screenshot. Yeah. Amalgamation illustration 6 point D. Okay, so amalgamation illustration 6. Let me just move on to that. So are you picking this from that amalgamation chapter? Is it? Okay, so amalgamation illustration 6. All right. So I'm on illustration 6. Okay, so now what do you need? Point D. Okay, so no worries. Let me just open that document over there only. Yeah? Okay, so if you say amalgamation illustration 6, I think this is page 13 point. Okay, so this seems to be the one. Correct. Now you're talking about point D. Okay, so in this case, let me just quickly look at. So there are two companies, best and better, and the information about best and better is given. So better has issued bonus shares. Then it was agreed that best will take over better. Okay, so that's the understanding. Now, liabilities of better limited included rupees 1 lakh due to best limited. Okay, for purchases from it. So what has happened? Better has purchased goods from best limited, on which best limited made a profit of 25% on cost. So it's an intercompany transaction. Yeah. The goods of rupees 50,000 out of sad purchases. So out of 1 lakh, 50,000 is the closing stock. So that has not been sold. So what will you do? I think you'll have to do the same thing. Okay, maybe I can just try to look at this part somewhere in the solution. Yeah, so this is more about that adjustment. So in this case, again, what will you need? The closing stock will have some unrealized profit. And I think we have just discussed this. So that unrealized profit, if that is there in respect of intercompany transaction, so you need to eliminate that. Yeah. So in this case, you can see on that 50,000, that unrealized profit, of course, you can compute the amount, I'm sure. You need to eliminate that. Okay. While this will be recorded by, so who's recording this? Best Limited. Correct? Yeah. So that needs to be eliminated. And where will it go? It will go to capital reserve. Okay. Clear? Yeah. Clear? All right. Any more questions? Okay, so Tanu is saying I'm not able to compute the amount. Okay, no worries. So if you are not able to compute the amount, so that's okay. So I think you want to reach to the amount. So how do you get 10,000? Is it? No worries, huh? So, and you want this to be discussed on working note. No worries, let's get on to a working file. I think just to help you, in the meantime, Hardik has shared this calculation. Yeah. So, but anyways, so the question says there's a profit markup of 25% on cost. Correct? So if the cost is 100, so what is the profit? 25. So which means in such a case, sales value will be 125. In such a case, sales value will be 125. Yeah. So now 50,000 stock that you see is what? Appearing at the sale value only. Appearing at the sale value only. This, out of this 50,000, what do you need to eliminate? You need to eliminate the unrealized profit. So how do you do that? 50,000 into 25 divided by 25. So you'll get 10,000. Okay. Now clear, hopefully. Tanu, now clear on this. So this is what you wanted. Yeah. So every time you get confused, so try to do this calculation, that on cost, this is the markup. So if 100 is the price, so this will be the profit. This will be the sale value. And now, because you have the sale value, so this is the sale value that you have. Yes or no? So on this sale value, if you have to eliminate the profit, so what will you do? You'll have to take this proportion. So if you do 25 divided by 100, that will go wrong. Understood? Clear? Then I understand I have got one more query of Hardik, which is left. I'll have to go through that and I'll have to come back on that. Yeah. In the meantime, if you have any other questions, any doubts, I would request you can just again send that to me with the illustration or maybe the question reference. I'll make a note of that and I'll try to come back on that. Okay. Okay. Yeah. So I think with this, we can just close our discussion for now. Okay. So in the next session, we are going to continue on associates. Yeah, so far we have just discussed briefly about the principle. So we are going to discuss some examples, some illustrations, and more about this equity method of accounting. Okay, so that's the plan. Okay, all right. Okay, so thanks everyone for your time and for this wonderful participation. Okay, so Manvi, I have noted your query. I understand this is from Consolidation. No worries, I have noted your query. Fine, noted, done. All right, so I think Manish, we can close this now.